Welcome to the Video CPA. It's nice to be with you again. You can see the disclaimers for the education disclaimer and the affiliate marketing disclaimer. I do have to say that I haven't made anything off affiliate marketing yet. I'm not even sure I have it set up right, but I am including the disclaimer in there. I mentioned last time in my last video that we would discuss the purchasing, depreciation, and sale of rental property in this video. And then I got to looking at it, and the video is going to be way too long, so I decided to make one video on the purchasing and the setting up of the basis, and then another one on depreciation, and then another one on the sale. So there's going to be 3 videos so that you don't have to listen to a 20-minute video. Instead, you can listen to maybe one that's 4 or 5 minutes. So it's nice to be with you today. Let's get into it. Today we talk about, like I say, the purchase of the property. When you complete the purchase of your rental property, you're going to receive in almost all cases what's called a HUD-1 settlement statement. And this is going to be your document for establishing your basis for depreciation on the rental property. Some items on this statement are going to be deductible, some are going to be amortized, and some are going to be included in your basis of the property for depreciation. So let's go ahead and talk about which is which on the next few slides. When you establish your basis, the first thing you're going to start with from that HUD-1 settlement statement is your purchase price of the property. Okay, and the mistake that most people make is that they'll put that purchase price on there, and that will be what they use for depreciation purposes. If an IRS audit agent comes in and audits you, he's going to look at that and he's going to say, well, you haven't subtracted a value for the land because land is not depreciable. So the first thing you need to do is apply as part of that purchase price a value for the land and subtract that from your purchase price. That way you won't be depreciating the land, so you won't be over depreciating. Now that land will come back if you sell the property, and that will be part of your basis in the property. Even though you may have depreciated everything else, you'll still have a basis in the property, and that will be the value that you allocated to the land. So the next thing you do then is look at those items that can be expensed. And usually on there's some real estate taxes, there's some mortgage interest, maybe some advance payments such as insurance payments. And you need to be a little bit careful here because some of the taxes and the interest will be reported to you at the end of the year. And so sometimes those things are reported from the closing statement at the end of the year, and sometimes they're not. So you need to look at the details and see if your real estate taxes on the closing statement are actually reported on your end of the year summary. And the same with the mortgage interest, because sometimes they pick it up, like I say, sometimes they don't. Once you've identified your expense items and expensed those in the current period, you need to look at items that have been deposited with the lender. These are things that are paid in advance or collected in advance, like insurance, like property taxes. Could be an earnest money, and there could be assessments of some kind. So take those into account. Those are not deductible. Those will be paid out at some point in time, and at that time you'll be notified by your lender that they are deductible, that they have been paid out. The next thing to look at then are those things that are associated with obtaining the loan. Those things like loan origination fees, loan discounts, points, appraisal fees, credit reports, inspection fees, mortgage insurance, application fees, things like that. Those are things that are attributed to the loan. Those things have to be amortized, and they have to be amortized over the life of the loan. So if it's a 30-year loan, you're amortizing it over 30 years, 15-year loan over 15, and so forth. But the amortization period is going to be different than your depreciation period on the actual structure of your rental property. Once you've established your basis for amortization, then you go ahead and establish your basis for depreciation. So in this case, you're going to add back in from the settlement statement some things that are not immediately deductible. And those are going to be settlement fees, title insurance, document preparation, attorney's fees, notary fees, recording fees, tax stamps, things like that. All of that stuff is going to have to be added into your basis of the property. Once you've got that done, well then you're ready to start depreciating. Okay, with those things in mind, you're ready to start depreciating your property. Just keep in mind, I mean, you can make some mistakes in this area, but as long as you are taking an amount out for your land and not throwing reserves in or expensing your reserves, you should be pretty close. You should be all right. If there's something on your settlement statement that you don't recognize, if it's loan related, put it with the loan and amortize it. If not, I would increase the basis and depreciate it if you have no idea. So next video, depreciation for rental properties. I'm glad that you listened. I hope this is helpful, and we'll see you on the next video.